Hi, welcome to Market in a Minute. Boy, March Madness, both in the stock market and then on the basketball court, right? So, on the basketball court, I tell you what, I think Duke looks incredible, and I love watching Auburn play. Their point guard, man, that guy is good. And the big guy in the middle, he's really talented as well. Love Auburn. I love to see Duke and Auburn in the finals. So we made a tactical shift. We went positive back on March 12th, and the markets forced us to go back negative again last week. So we broke that 200 day. I'll show you what we're talking about. We broke the 200 day and had to get out of the way of it. So we got a little bit of a gain there. That was nice. The S&P 500 needs to hold 5,500. Otherwise, I think we're going to see another leg down in the overall markets. So this week we have tariffs on Wednesday, and then we have the employment report on Friday. So no clue about the tariffs. I don't know how those are going to come out. I just know that the market is positioned pretty negatively looking at the tariffs, and the employment report needs to hit it. They just need to hit it just right. So there is a lot of uncertainty in the overall markets. The markets needs clarity. So it needs clarity on a number of fronts. First, it needs clarity on the tariffs. What are these tariffs going to look like, and how's it going to impact both our economy and the global economy? So that's a big unknown, and Wednesday hopefully will resolve that. And then the economy. So is the economy slowing down even before the tariffs actually hit? It's slowing down, and how slow is it going to get? Are we going to roll into a recession? The first quarter looks negative, so we think that's going to turn out to be the first quarter of potentially maybe the second quarter is negative or the third quarter is negative, but it's not a really robust economy at this point. Earnings. We need clarity on earnings for this quarter. Let's figure out what this quarter looks like. But more importantly, for the uptrend to occur, we need 2026 clarity. So I think we're getting clarity on tech spending for AI. I think that's becoming obvious that we're somewhere in maybe the near term, this year, next year, whatever, being somewhat the peak. So maybe next year's down, and if people start making money on their AI investments, then maybe it heats up again. But we're thinking that the market is kind of in that point where it is discounting the peaking of the of the spending in AI. And then geopolitics. Geopolitics are a concern, and the Russian-Ukraine situation, it needs to be ironed out. So it would not be good if we put sanctions or tariffs on all the Russians' trading partners. That's just probably going to end up really ugly if it happens. Inflation, we're not concerned about inflation. We think inflation's rolling over. So that's one of the things that I think the market's still concerned about, that we have clarity. The technicals are negative, and the next slide we'll talk about the technicals of the markets and how we're dealing with it. The valuation of the markets, as we mentioned in the last couple of weeks, it's gotten a lot better. So we think that the valuation of the unweighted part of the S&P 500 is roughly about 16 times. So that's pretty attractive. The mid-cap stocks are 14 times, and the small caps are about 14 times. I love these blue wings by Ed Yardeni. You can see that rarely the S&P 500 is above 22 times. Now it got to 24 times back in 2000, and that's the highest it's been. But now back to 20, but the average stock at 16. Be nice to flesh out some of those tech stocks some more. And then the mid-cap stocks, you can see here that they get up to roughly 20 times in an expansion mode, and it's been roughly flat in terms of its PE expansion for quite a long period of time now. Um, and then you can see same way with the small cap stocks, they've actually gotten nicely cheaper. So from 20 down to 14 times. So we want to be in those small to mid cap stocks when the economy visibility is starting to improve. They're going to have a nice big run. Credit spreads. This is important for the economy, but we see a little bit of deterioration in the credit spreads, and the dollar needs to hang in there, okay, to make sure we're financing all this debt. We don't want the dollar to go up a lot or go down a lot. We just need it to be stable. So the technicals. This is a good way to kind of review our tactical strategies, how we do them. So we don't all only have tactical strategies at my firm. We also have strategies where we're moderating the risk by just the individual stocks or the asset allocation. We modify the asset allocation a little bit, but our tactical strategies can move really big one way or the other. So we can go from fully invested to having no market exposure, so being hedged completely. So as you can see here, we broke the 20-day and then the 50-day and then the 100-day. We like to use 3 different moving averages to run our model. So it could be different ones than we have up here. But as it breaks this 100-day, we wanted to be out of the markets. So have that hedge in place. Now we got way oversold here. So you can see how this oscillator got way right down here and it gave us a buy signal. And so generally we use moving averages, but given the reason the sentiment was really negative, and it currently still is, we got a nice oversold condition. We said, okay, we're going to get a counter trend rally here. And we got some investments made into 3 different indexes. So it went back above the 200-day, and then it rolled back down again. So above the 200-day and then rolled down. And then that forced us, as it broke the 200-day, to get rid of those positions that we just bought, because we knew it was going to be a counter trend rally and it wasn't going to go all that far. I was thinking maybe it'd go back up here to the 50-day, but it broke it back down to the 200-day and gave us that sell signal. So how we're positioned currently is we're very defensively positioned in our tactical strategies. The technicals don't look great. We think if they break this level here, 5,500 on the S&P, there's not a lot of downside support here. So we think that it's going to go down for a while, and it'll likely be driven by some sort of real negative news. We think that the hedge funds are positioned very negatively. They were really long positioned in tech going into the year, and they got their butts kicked. So from the trading desk that we work with, we're hearing a lot of negative feedback on how the hedge funds have been doing, how they're down quite a bit for the quarter, and how they maybe have reversed that position to being, more aggressive on the short side. So we think that any sort of positive news, like on the tariffs, will spark that short covering. So you got hedge funds that are behind the 8 ball. They've had a bad start to the year. They can't afford to have a big up move in the overall market and then be, too short on that. So the credit spreads. As you look at this is a single B. So as you know, it goes AAA all the way down to C. So triple B is investment grade. Single B is nicely below investment grade, but above the C quality sort of credits. And you can see over the long term here, you get down to about 2.5. The spread between the single B and the Treasury, only 2.5, is more or less the bottom. So we're a little concerned that this is the bottom of the credit cycle, and it's going to deteriorate from here. We'll have to see how much it does deteriorate, and it's starting to do that. So this is always a big issue with the stock market. What's happening with the lower quality credits, bonds in the markets because it impacts companies greatly. So it's gone from roughly 2.6 in January to roughly 3.6 today. I know on a long-term chart you can barely see that little move up there, but on a shorter-term chart, that's quite a move. It's a 1% move in the spread. So we wouldn't be surprised if we roll into a recession that these spreads really widen out and become a bigger problem for the overall economy. Now we're not seeing any major signs of that occurring at this point. We just see that the bond market, what the bond market is saying, is that, hey, wake up here. The economy is slowing down, and we want some defense put in place. So we're getting out of some of the lower quality bonds. So the bond market is protecting itself. So it's moving up in terms of quality. So something to keep them in mind. So if we get a 2022 sort of event where we have two maybe technical quarters of negative GDP growth, we're probably going back above 5 on the spread, and it's going to freak the stock. Now the dollar, I mentioned the dollar. So the dollar's down a little bit. So in the short term, it's a nice move down in the dollar. That'll help actually our exports. You know, at some point this year, this might turn into a positive as we're getting currency gains instead of currency losses through the internationally, driven companies in the S&P 500. So it's been a headwind. Maybe it'll turn into a tailwind in terms of earnings growth. However, we want to keep the dollar relatively stable because that finances our debt. Foreign countries buying our dollar helps finance our debt. So we don't want big movements one way or the other. So if we totally piss off all of the countries we do business with by tariffs, we would expect that the dollar would deteriorate a little bit and then kind of strengthen. So that's something to keep in mind. If the dollar really deteriorates, it's going to become a problem to finance our debt. Now, one thing I want to bring up before we wrap this up, we've been investors in Dollar Tree, DLTR, right? We mentioned on the video quite a bit, and Mark in a minute. They sold Family Dollar. So that was a catalyst we were looking for. They sold it, but they only sold it for $1 billion. These guys bought it for $9 billion about 10 years ago, and they're selling it for $1 billion. That's a shame. They needed to get that thing spruced up, and if they wanted to divest it somewhere closer to $9 billion. But anyhow, they sold it just to get rid of it, maybe too much of a headache. This is not the type of management teams we want to invest in. So as the stock popped, we got out of it, and we're not looking back. Dollar Tree's off our list. It was too much of a bungled move on their part to have any confidence in this company going forward. Thank you very much. If you would come to my website, Patrick M. CFA, sign up for a hard copy of Mark in a Minute. We'll send that to you by email every week. And if you ever need anything, just ping us. Or if you want to become a client or talk about becoming a client, just let us know as well. Just contact us through the website. Take care.